Beyond trade and tariffs, a new data point for the Fed to consider for its July rate decision. And their inflation gauge today showing prices rose a little more than expected. 0.1 in May, 2.3%. Ex-food and energy, the core was in slightly hotter. That was up 0.2 tenths, we'll call it, to an annual rate of 2.7%. Treasury yields not moving much on the data. The 2-year, let's see, their yield around 373. We've got the 10-year around 427. Our next guest says today's data is likely not enough for the Fed to budge on interest rates next month. That will happen only after they get more clarity on tariffs and trade. Ellen Zenter is chief economic strategist and global head of thematic and macro investing at Morgan Stanley Wealth Management. Ellen, it's good to see you. And now maybe throw another Canada tariff into the mix. Welcome.
Yeah, thanks, Kelly. Good to see you and Brian.
Yeah, so what do you think? We were speaking with Dean Mackey last hour, and he actually thinks that this could keep the Fed on hold till December, all of this kind of the tariff taxes and the way the consumer reacts to that.
It's possible, but gosh, there is a lot stirring in the pot here. So you talked about core PCE coming in today, 2.7% year over year. But there are those on the Fed that really like a shorter term trend metric of that. The 3-month annualized rate of change in core PCE is below the Fed's goal. So if you're a Governor Bowman, if you're a Governor Waller, and they're probably not the only ones on the Fed that would point to that and say, hey, what if we're wrong on tariffs coming through? Maybe companies are absorbing more of this. And yes, that means margins are going to be hit, and maybe that means more layoffs, but maybe it means the inflationary impact is just not what we think it's going to be. So I think the arguments toward cutting are going to grow on the FOMC, but I just don't think they're going to be able to get consensus by this July meeting.
Your firm, I think, is predicting, a lot of cuts next year, maybe 7 all told. So, I mean, would you kind of emphasize that dovish view that to the president or anyone, just wait till next year and we could actually see quite a few rate cuts?
Yeah, so I think the Morgan Stanley on the institutional side, Michael Gapin, our excellent chief U.S. economist, they are predicting that they don't cut until March and that they do cut 7 times. And that's based on an expectation that growth continues to slow next year, that inflation is coming down pretty hard then because while the unemployment rate is rising, because you've got that annual lap around the base effect of tariffs. So if that's right, then the Fed should be cutting a lot next year. I do think that they acknowledge that the risks are to an earlier start to the cutting. But here's, if the Fed is going to be contending with a possible shadow chair or trying to understand who might come in to replace Chair Powell when he steps down in May of next year, the Fed is probably already going to be in a cutting cycle. So it's not going to be that a new Fed chair comes in and there's all that much difference in the policy that they would have implemented anyway.
It's almost like you watched yesterday's show, Ellen, because we talked about this very topic, about who the next Fed chair is, because the reality is this: the market's breaking up with Jay Powell. It's like you're dating somebody, like, in 9 months, we're going to break up. But at some point, you just start looking around, and Trump's already looking around. We highlighted some of the candidates, or we got them on our wall: Kevin Warsh, Kevin Hassett, Scott Bessent, David Malpass, Chris Waller, maybe Ellen Zentner. Who knows? Well, maybe you could say if you're a candidate.
I don't take those calls.
Yeah, okay. We'll take your name off.
That means you might get them. You didn't say you don't get them.
Yeah.
Is any one of these, and they're all men, any one of these men better for the stock market than anybody else?
Well, I think so. That's going to be interesting because the stock market might love whichever one would represent lower rates than another leader. But at the same time, the bond market might say, no, if they're going to appoint someone that's a mouthpiece for the president that's not going to give careful consideration to the economy and the needs of the economy, then the term premium at the long end may raise higher. And then that's going to weigh on stocks. And in the end, I think there is a healthy list here of capable possible leaders for the Fed. And so, I think that the Senate ultimately wants to go with somebody that's probably been through the process before. You're asking for the Senate to give up 2 votes for somebody to get to Fed chair, and they've probably got a lot on their plate. Also, it's not unusual to get the suggestions this early. And let's be fair and let's be patient. those names may shift around, and the president could settle on one name to put at the forefront, and that person could fall out of favor well before Chair Powell steps down.
It's great points, because you do wonder who's going to be really in charge, the Federal Reserve or the bond market. Methinks it will ultimately be the bond market. Ellen Zentner, really appreciate your views as always. Thank you very much.